Well, hello and welcome to another episode of the Legal Gym podcast. Thank you so much for joining me today. Today, we're going to be talking about how to save money on taxes with my good friend and special guest, Navi Maraj. Navi is a one-of-a-kind accountant. He believes in service first and as such has actually limited the number of clients that he will work with at any given time. And I can tell you this from personal experience because I asked Navi to serve as my accountant and he actually turned me down. Anyway, we are going to get into all of that and a whole lot more in today's episode. And as always, for the show notes for today's episode, which will include all of the links and resources for everything that I'm going to be discussing today, make sure you head on over to hawthornelaw.net/Navi. That's spelled Navi. That's hawthornelaw.net/Navi. All right, let's dive into today's episode. All right. Hey, Navi, good to talk with you again. Great to have you on the show today. How are you doing?
I'm doing well. Thanks so much for having me. I really appreciate it.
Yeah. So, obviously you're an accountant. You work with small businesses. You work with online entrepreneurs. Why don't you tell us a little bit about, kind of who you are, what you do, who you work with, all the important stuff that the listeners need to know about before we jump into today's episode.
Sure. So like a quick rundown would be, my name is Navi Maraj. I'm a CPA. Long story short, started my career in banking, moved into what's called like Big Four public accounting, working for a large CPA firm. And I basically take what I've learned working with small businesses in the banking world and large businesses in the auditing world, and now help small business owners. So my whole thing is trying to get them to save thousands of dollars in taxes by implementing strategies in their business. So kind of have a YouTube channel that talks about that stuff. And I serve clients around the country, mainly in the US.
Yeah. And we actually met because I found you on YouTube and you had an incredibly helpful video because I talk so much about S Corps on this channel. People would think, oh, well, certainly he's not going to mess that up. But I did mess that up this year and you were able to help me fix that. And so that's kind of how we met. And I won't get too much into the details of that, but anyway, so yeah, where do you want to go today? Like, what do you think is most important for the listeners to know about taxes? We're coming up on tax season right now. Why don't you just kick it off and let us know kind of what do you think people need to know? And then we can kind of dive deeper into that.
Sure. I think broadly speaking, I would want your audience to know that we're not all the same. So like there's various types of people that prepare taxes and we're not all the same.
We're not all the same, meaning we as accountants are not all the same.
Yeah. So to expand on that, I'm saying like you can get someone who can prepare a tax return who I would refer to as a tax preparer. So like if I think about the different levels of this, there might be like TurboTax, right? That's like self-preparing. Then you can hire a tax preparer. That's not necessarily an official term that I'm using, but like I think of the tax preparer as like the human version of TurboTax. So you have an actual person helping you fill out the forms. Then you have, I would say, credentialed people helping you. So those people would usually be like enrolled agents or CPAs. And then you have like what I call the tax strategist category, which they could be any of the other people that I just mentioned, probably with the exception of self-prepared, but they focus on helping entrepreneurs save money in taxes by leveraging the tax code and the tax strategies out there. So that's one thing I'd want your audience to understand is that like, don't assume that just by hiring someone to prepare your return, that person is doing everything they can to help you save money in taxes. That's a huge misconception. And then maybe the second major point is that, given what I just said, is that there's lots of strategies that even licensed professionals like CPAs and enrolled agents just don't help their clients implement due to a shortage of time. Like it's really interesting the way the industry works once you're in it and behind the scenes. We can expand on that, but I don't want to go on too much of a tangent there. If you think your audience is interested in it, we could talk about it. But I just don't think consumers or business owners realize that they really need to seek out a tax strategist if they want to get help and save as much as they can in taxes.
Yeah. So I do want to touch on that because that's really interesting to me. And nobody's ever told me that before. So I don't know that I was aware of this. So why don't you talk more about that specifically? you said that number one, not all tax preparers are the same, which I totally understand. The differences between. Okay. Yeah. So I was not aware that there was kind of a difference between these different categories of people, and that somebody that you're paying as a paid tax strategist might not be giving you all the best advice that they could be giving you about your situation because of what you said, lack of time. So can you talk more about that?
Yeah, let's unpack that a little bit. So like I might get in trouble for this, but let me give you a view into what the industry is really like behind the scenes, okay? So I would say over the past, I don't know, I'm just gonna throw this out there, 50 years or so, the way most tax preparers run their business is a quantity over quality type of business. So what I mean by that is they take in all different types of clients. If they've got a small business, they want to help you. And they're only concerned with capturing their fee for preparing your tax return. So as a result, what happens is you'll have a tax professional that has hundreds of clients. I mean, I once worked for a tax professional that had, I think, 600 clients. And if you think about it, like if they're charging, let's just say, I don't know, $600 a return, in order for them to make money for helping all those clients, they've got to spend maybe 2 hours total with you as a business owner to make sure that they're profitable by running their business that way. And so as a result of that, what happens is they literally say like, hey, Jim, what are your numbers? They take the numbers and they put it in their tax software. And if I'm really being honest and giving you like the deep insight as to what's going on, is they probably have a very junior person putting the numbers in their software. They give it a high level review and sign off on it and prepare the return. And it's just a model that makes no sense in my opinion, because the customer service experience is bad. That's why when you call these people, like they don't respond to emails and they don't return phone calls. It's because they're so busy. All 600 of their clients are reaching out to them during one peak period of time. And quite honestly, it's a high stress environment based on that sort of model. So compare that with someone, and I don't mean to say this as like an advertisement for myself. I'm just saying there's firms.
Wait, but before you go any further, I just want to make sure I'm clear. So are we talking about accountants that do personal tax returns or business tax returns or both?
I would say both. I would say both operate that way. The way I operate, and again, it's not an infomercial for myself, but the way I operate and sort of the newer firms out there operate is much differently, where they have much less quantity of clients, but a higher quality, or at least can spend more time with each client. And so it's very proactive instead of reactive. Typically in that other arrangement I just explained, what happens is the business owner goes to them many, many years and then eventually asks the CPA or tax professional, hey, is there anything I can do to help save money in taxes? Like my tax bill just keeps growing and growing. And then the CPA at that time will say, well, yeah, we could do this, or maybe you could be an S corporation, or yeah, we should be doing these other, strategies and what have you. And then they're like, well, why didn't you tell me that like for the last 3 or 4 years? And so there's this big disconnect where the tax preparer assumes that the client understands that they are just preparing the tax return and that's the only service they're getting here. Whereas the consumer is under the assumption that, hey, I'm hiring this person. They must be doing everything they can to save me money in taxes, right? And that conversation never happens until like year 3, 4, and 5. And once the customer figures that out, they're like, well, why weren't you helping me? And that's usually when someone like myself gets involved, because the client gets fed up. They reach out to someone like myself, and then we start kind of showing them the different way to kind of handle these things and being much more proactive with it.
So that's so interesting. So you mentioned tax preparer. So when it comes to a tax preparer, I've always had in my mind, and this is based on nothing than just personal experience, a tax preparer is someone. Like I used to be in BNI. Have you ever been in BNI? Or do you know what BNI is?
I'm familiar with the acronym, but I've never was like in it.
So there's always like a tax preparer in the BNI. And there was a guy in our BNI group who was a tax preparer, and he was basically what you just talked about. He was like a human version of TurboTax, right? You gave him all the information and he prepared a tax return, signed it, that was it. So that's a tax preparer in my mind, versus when you move to like a CPA or an accountant, there's somebody who's taken the CPA exam, they know tax strategies, and so they typically would give you advice and guidance on how to prepare your taxes. But I think what you're saying is that the line between these two people, this tax preparer who's maybe not a CPA and a CPA, are really not that. There's really not this clear line. They're kind of the CPA might charge more because there's a CPA, but they're still doing the same stuff that the tax preparer who's not a CPA would be doing. You're basically just paying a little bit more to have a CPA do it, but they're doing the same thing. Is that right?
That's correct. I would say the nuance there is like the CPA is probably doing it properly because they have more on the line to lose. Like they want to make sure that like, hey, they don't want to do anything bad that messes up their reputation and things like this. Sometimes that hurts the CPA. Sometimes that they may be a little bit more conservative. So I guess what I'm trying to say is add on one more layer. So we have tax preparer, we have CPA, but in your mind, like carve out another layer for sort of someone who's more focused on helping their clients save money in taxes by implementing strategies proactively. And that I don't want you to think like there's this official designation out there called tax strategist. It just happens to be that someone who's just a tax preparer can be doing that. Someone who's a CPA can also be that tax strategist. But then you generally have people like myself and others out there that like proactively tell folks like, hey, this is the type of service I offer. I'm not going to just take your numbers and throw them in the tax software.
So how does somebody know? And then I want to get into some tax strategies too. But so how does somebody know when they go to hire somebody who they're dealing with? Like, how do they realize that up front?
Hopefully they listen to this podcast and they hear what we're talking about and can finally realize this. I mean, I created a YouTube video about the same topic, and a lot of the comments in there are like, wow, I never really thought about it this way. I didn't even know this was like a thing, kind of like the revelation that you're kind of having right now. So I would say the way I would answer that question is, nowadays the consumer is pretty educated. And so they get a lot of their education from YouTube. And so when you'll know the channels out there with people talking strategy, I would say come up with your list of questions that you have. And when sort of interviewing candidates who you want to be your, tax preparer or tax professional, start asking them these questions. And if they do a lot of or pauses or pushback, then you're probably not working with the right person.
Okay.
And that's a good segue into like, okay, well, what are the questions, right? Like what things can we deduct, to start feeling that out?
Yeah. And I think the other thing there is if you can even get somebody on the phone, like right now it's March. So this is probably this podcast will, we'll publish this either next week or the week after. And like this time of year specifically, it's almost impossible to even get a CPA to talk to you, right? Because they're so busy. So if they're the ones that are, like you talked about, that have like 600 clients that they're dealing with all the time, then they might not have time to even be taking on new clients or talking to people. And so that might be an indication also.
There's a shortage of CPAs. Actually, it's actually been, not on the national news or anything like that, but within the sort of the CPA community. So they are challenging to find one. So that certainly is accurate, and it's going to be probably tougher and tougher because the regulatory body is having trouble getting more people to be CPAs right now.
Interesting. So you started to mention questions. So what type of questions could people be asking to figure out who they're dealing with?
So, I mean, to prepare for our conversation today, I came up really quickly with like 15 things that people should be implementing, or small business owners should be implementing as strategies in their business. So I'm going to quickly run through them, like literally just laundry list them. And then maybe like the more strategy related ones are towards the end. So I think everyone should be deducting home office, cell phone, internet, their vehicle, assuming they use it in their business, electronics like smartphones, cameras, laptops, social media subscriptions like YouTube Premium, Twitter, board meetings, travel, meals, hiring their minor children. This is more of a strategy now, or probably things I just said above, probably not so much strategy. The things I'm about to say are more strategy related. Hiring your minor children, that's strategy like number one. And then like exponentially increasing that strategy by funding retirement accounts for those minor children that you're paying. Medical, a lot of people are frustrated, rightfully so, with medical, but as a small business owner, you should be deducting your premiums. If you're specifically running your business as an S corporation, then there's a way to incorporate those health insurance premiums to save an additional 15% in taxes. And for folks that have high medical expenses, and I'm defining high as like maybe they have a health insurance plan, but they're still paying $5,000 or more for health insurance. There's something called an HRA, health reimbursement arrangement, to deduct those high costs. HSA accounts, health savings accounts. You touched on it earlier, the tax classification. So, hey, does it make sense for me to be taxed as a sole proprietor, or should I make that switch over to S corporation? Retirement accounts. So you have, obviously everyone knows the IRA, but we also have SEP IRAs, solo 401ks. You can self-direct your retirement account, meaning you can invest in what you know. So there's folks out there that have rental property within their retirement accounts. And then I would say within the last couple of years, for folks that invest in real estate, the whole it's kind of called short-term rental loophole. We can dive into that, but basically, if you have Airbnbs, and you also earn high wages, so you have high earned income, maybe through your regular operational business, you can sort of marry those strategies together and come up with losses on your real estate that help offset the earned income you have through your business.
Wow, that was a lot. Okay. So let's try and unpack that. I wasn't taking notes, so we might have to go back through. So what would you say would be okay, so just keeping in mind the people that are probably listening to this, a lot of people are just starting out, revenue is not like super great. It would seem to me, and tell me if I'm wrong, you said one of the most important strategies was like hiring a minor child. And I guess, what does that look like when you say hiring them? What are you actually having them do work, or are you just putting them on payroll, or what does that really mean? Is that really something that somebody who, is just starting out and is making, less than $100,000 or maybe a little more than that? Is that something they can realistically do?
Yeah, for sure. We need to define this. So I won't really unpack the strategy too much because that could be a podcast in and of itself. But I would say, minor children, I'm defining as age 17 and younger. And I would say you're typically not really hiring them in your business until the age 7 is probably reasonable, because that's when they're at the age where they can maybe start helping with a little bit of stuff. And then as they progress towards, maybe at 7 years old, they're doing something very basic, like cleaning up your home office and things like that. But as they get into their teens, they're doing other things, like they might be better at social media than you are by the time they're in their teens, right? So like some of them really take on, editing videos and things like this as they go into their teens. Now, I want to let you know that we're not actually putting them on payroll. So we're not going to have them as an employee in your payroll system like the business owner might be. And I don't want to confuse your audience here, but yeah. I'm saying this is where you're an S corporation. And so you, the owner of the business, are on legit payroll, but your minor child is not going to be paying FICA taxes, or they're not going to be paying Social Security and Medicare taxes and things like this. But to take a step back, the thought process should be this: kids are not cheap, right? They cost you thousands of dollars a year. So as opposed to, running your business, paying taxes, and then taking that after-tax money and paying for the stuff that your kid needs, if they're able to, get them involved in the business, pay them a reasonable amount of money for the services that they're providing, and get a tax deduction for doing it. And so it's a win-win. You get a tax deduction, your minor child is earning income, and you're using that money to either pay for the stuff that you would be buying for them anyway, right? So that's sort of the very basic way to think about the strategy. But you can pour like rocket fuel on it by taking it a step further. For example, as a minor child, let's say they get started in the business at 7 years old, right? And at 7, you're not paying them thousands of dollars. It might be $100 a month, right? But think about the fact that if you start now that that minor child has earned income, think about how powerful it could be if you then couple that with starting them out with a Roth IRA. So now they're contributing $100 a month to a Roth IRA that's growing, depending on what they have it invested in at, let's just call it 8%. You know, you know how they say like it's not timing the market, it's time in the market. So if you could start at age 7 instead of age, 20 something or 30 something like the rest of us typically start at, your money is compounding and growing, and you're really setting up your children for financial success.
Oh, that's kind of cool. I never thought about it that way. So you're not actually putting them on payroll. You're just paying them as a contractor. Like, how does that work on the books? Like, what are you doing?
Yeah. So the mechanics there, they're not on the actual payroll system. They would be if they're 18 and older, right? But we're talking minor children here. And so how you navigate this strategy depends on how your business is taxed. So I think your audience is largely taxed either as sole proprietors, so they're not quite ready for the S corporation, or they're taxed as an S corporation. For those folks that their business is still taxed as a sole proprietorship, they can pay the minor children directly out of their business account. So that's literally an online banking transfer, a check, Zelle, make it easy. But you do want to have, set up some sort of fiduciary account for your child so that you are transferring the money directly into their, personal account. You don't want to be doing a transfer into your personal account.
Although that'd be great. I mean, if we could do that, but it's probably not legal.
Yeah. And then I guess in your bookkeeping software, assuming your audience has that, if not, they might be using a spreadsheet or what have you in the beginning. But you might want to code that as something called like outside labor, right? So that's the expense that's on the books of the business, outside labor. So that's as easy as it is for the sole proprietorship. For the S corporation, there's 2 ways to handle it. Okay, there's the non-tax strategist way. So first of all, hiring your minor children in and of itself is a tax strategy, right? Now, let's say you knew about that because you're listening to this podcast, you're learning about it. You can pay your minor children out of your S corporation directly. And if you do it that way, they have to be on payroll. And what that means is, and I know you know this, Jim, but like if they're actually on payroll, then it takes away from the strength of the deduction, because now you do have to pay Social Security and Medicare taxes on those wages. But the strategy is, instead of paying them directly out of the S corporation, you typically would set up a separate sole proprietorship business. And that sole proprietorship business is typically called like a family management company. So let's, I don't want to use you in particular as an example, Jim, but let's say Jim is the S corporation owner, and his spouse Jane could be the owner
let's
of
not
this
get
family.
confused. I don't have another way.
Oh, okay. We don't want to have any issues there, right? Yeah. Sorry, Donna. So let's say Donna is the owner of this family management company, and so she's sort of in charge of giving. Basically, what's happening is the family management company is charging like a management service fee to the S corporation. So there's an expense going out of the S corporation. That expense is income or revenue to the family management company. And then the family management company has an expense, which is paying those minor children. And so it's like a hop, like if you're a sole proprietorship, it's just one hop, like, business to personal. But with the S corporation, it's like 2 hops. You got to hop to the family management company and then to paying the minor children.
No, that makes sense. Okay, cool. Well, that's a good strategy. So what other strategies maybe we can focus on because I know there's a lot of strategies. There's really 2 phases, right? And I don't know if I'm saying that right, but you've got these end of year strategies that you can take advantage of if you do them before December 31st. But then there's also a bunch of strategies that you can still do that you can take advantage of between January 1st and either April 15th when you file your tax return, or in the event if you're like an S corporation like I am and you file an extension, you could do it until you file your S corporation return, and maybe that's not going to happen until September or October, whenever it is. So, so maybe we can focus on, are there some of those strategies that people could still be implementing now that they can take advantage of before April 15th or next fall when they file their tax returns?
My initial gut reaction might sound silly, but I'm with my client base and the way I educate folks on YouTube, like I'm so proactive that I don't even do any of the reactive stuff, right? So all these, what I mean by this is like all these strategies that I'm talking about are like baked into your financials during the year as they're happening, so that you don't have this like, oh crap event, like you're preparing your tax return, you see how much you owe, and you're trying to back into some tax strategies. Having said that, what comes to mind based on what you said is like at that point you're limiting yourself. So you could probably do a traditional IRA if you want a deduction, right? You could do Roth or traditional, but the traditional IRA comes to mind. That's something you can do until generally April 15th. So that's a little caveat there, Jim. Like even if you file an extension, you have only until April 15th to fund regular IRAs. Yeah. Then next level is you could do the SEP IRA, SEP IRA. That is something that you can institute after the tax year is over. So you have until the filing extension to do that. So like keep in mind, you got to file the extension in order to be able to wait until September or October to do that. But yes, you can do there's a formula involved in it. I believe it's either 20 to 25% of the gross profit of your business that you can sort of put into a retirement account. Yeah. And then you have there's so many online calculators you could kind of throw in your numbers and get an estimate as to what you would be able to contribute. And then other than that, you can also do the solo 401k. That's new, actually, recently an amendment to the law. And so previously, you needed to set up that solo 401k prior to 12/31 to take any deduction for that. But now you can actually establish that solo 401k after 12/31. However, the caveat is you can only do the employer portion of the contribution at that time. You can't go back in time and sort of do the employee contribution.
And the distinction, I think the employer is something like $20,000 or something like that, but the employee contribution is like 50 or 60,000 now. I don't know what the max is. It's much higher.
That's right. So to unpack that just a little bit is like in 2022, I believe it was $20,500 that the employee can, if they're an S corporation, sort of defer from their salary and contribute to the solo 401k. And the employer contribution typically is, again, this is for the S corporation, 25% of the wages that were paid.
Yes. Okay. Yeah. No, that makes sense. Up to a certain amount. So there's a maximum amount. Yeah. Okay. So then let's take a step back, because since you're thinking about this more holistically, it sounds like is the way you do it with your clients. What are, because being cognizant of your time, what are maybe one or two strategies that you think are really, really powerful, but they're severely underused by people? And not talking about the ones we've already talked about, but what is it that you think is out there that, if people are listening, it's like, this is what you should be doing, but most people aren't, like the secrets.
Yeah. I think since we already touched on it, but the hiring the minor children one is huge. Like we really, really need to seriously start considering that. And then after that, I think the retirement account. So you alluded to it a moment ago, but I believe for 2023, you can contribute up to $66,000. Now, I know not everyone even has that much of profit in their business just yet, right? But you grow there, you get there eventually. But you can contribute up to $66,000 into your retirement account. And then you can do something called like the backdoor Roth IRA as well. So for folks that are hearing this for the first time, you can, the term is like, you can walk through the front door with a Roth IRA. Okay. And you can go through the front. Exactly. And so once you hit that income limitation, a lot of people are like, well, I'm stuck. I can't do that. So I got to move on. but there's, something called sort of the backdoor Roth IRA where you can get around that income limitation. So when you add the 66,000 that you could do plus the backdoor Roth IRA, you could contribute $72,000 to a retirement account. And I think that's a massive one. Now, and when I say $72,000, I'm talking all of this is Roth money. Okay, so it's after-tax dollars, and people might think, well, Navi, that doesn't help me in terms of a tax deduction. You're right, it doesn't help you in terms of a tax deduction now, but you'll never pay tax on that money again, regardless of what it grows to. So imagine, throwing in 72 grand into a retirement account today, whatever it grows to 20 years from now, 30 years from now, let's say it's, I don't know, just throw out a number there, $300,000. You don't have to pay tax on that when you pull that money out after age 59 and a half. So I think that's a underutilized strategy because people aren't actually informed that you can do that. And it makes sense in my mind, but maybe not in your audience's mind. So let me just touch on a little nuance there. We talked about deferring. I can't remember the number for 2023. I think it's 22,500 for 2023. So that's something they might know about. They're like, okay, I can defer 22,000 into a Roth account. But Navi, I thought anything else I can contribute would be pre-tax dollars. So I would get a deduction for that. How are you putting in, $66,000 into Roth money? Well, you can't really do it when you're working with one of these brokers like an E-Trade or a Vanguard, or their documents are not set up to be able to do that. But if you work with some of these other companies out there, you can do what's called a voluntary after-tax contribution. And then you go through a conversion step. You then convert those dollars to Roth dollars. And so that's how you're actually able to get in, $72,000 in a single year of Roth money.
No, I think that makes a lot of sense. And I know because we have some friends back in the States that do this every year, and they've got like a standing like task to deal with their accountant to deal with this, and they deal with it like whenever the date is that they have to do it. I don't know what the deadline is. But yeah, and I think they use Schwab. I think I use Fidelity for a lot of my investments, and I think that Fidelity might allow that also. But yeah, no, that's definitely a very powerful strategy for, especially once you get to the point where you're over those income limits on the Roth. So I think another strategy that kind of goes hand in hand, which is very similar to this, and you don't have to worry about these backdoor strategies, and you tell me what you think, is the HSA deduction. And I think that's incredibly powerful because unless they change the law, there's no income limitation on HSA. Is that right?
That's correct. There is none. Right.
Yeah. So
the HSA could be very powerful.
Yeah. So the way that I've been doing it, and you're the accountant, so you tell me if I'm like totally messing this up. But the way that I do it is we contribute a lot of money to the HSA. Then what I do is every time we have a doctor's bill, we save the receipt. I basically scan it and I put it in a Dropbox and I just save it. And I never seek a withdrawal from the HSA. And so at some point here in the future, I'm going to need to, if I need money from the HSA and that money continues to grow, then I can just use all those receipts and take a withdrawal from the HSA, and that will also be tax-free. I'm not only the withdrawal, but also the growth of the money. So that's what I've been doing. I don't know if that's a good strategy, if I'm messing that up, but I think I'm getting that right.
No, I think you're doing a great job there. So I think, the HSA is great in and of itself, even if you use it as it's intended to, right? So maybe we could walk the audience through that. So you contribute, I'm just going to say 7,300. I think that's the max this year, something close to that. You contribute that money, and as soon as you contribute it, you get the deduction. Okay. So it's not like right. So like you get the deduction, you don't actually have to incur the medical expense and pull the money out to receive the deduction. You get the deduction just by contributing. And then when you do have a medical expense that you want to pay for, you use it like you kind of just mentioned. Like you can get a reimbursement from the health savings account administrator, right, by submitting a receipt and getting your money out. That's sort of the most basic way that it's intended to be used. but you can do things even crazier with it. So like, let's say you didn't need the money. If you have enough, profit in your business where you're paying your bills and you actually didn't need to seek the reimbursement, you could invest that HSA money. And I think you were alluding to
Yeah,
that. I
that's what
think
I
you said
do.
you even do that. Yeah. But there's a lot of folks out there who have their HSA dollars just sitting in like
Cash.
a regular account. Yeah. Not doing anything. In fact, deflating, right? Due to inflation, losing its value over time. So there's not a lot of brokers out there. I think Fidelity is one of them where they allow you to invest your HSA dollars that you're putting in there. Yeah. And so you could then take it a step further. Now, this takes some time, right? But like eventually, if you really wanted to, let's say you did this for, I don't know, 5 years. And so now you've got close to 50 grand in there, maybe more because you're earning some profits there because you have the money invested. Like you can actually self-direct your HSA. So there's like it takes some time, right? But like there are people out there that have rental property within their HSA account. It's a little complicated, but like, you would walk through a professional would do that for you. But think about this. While you're healthy, you're contributing money, you accumulate enough funds in there to acquire, the cheapest rental property you could kind of find. But now your tenant is paying you monthly rent, and it's that monthly rent that's helping you pay for all your medical expenses now that you're, like old and fragile, right? And you actually need to pull out the money and you have those expenses. So it's pretty crazy. If that's like blowing the mind of some of the people on the audience, stick to the basic strategy, but just know that you can leverage it even further if you want to.
Yeah, and the general idea being that if you don't need the money out of that HSA, you don't need to necessarily do self-directing now, but when you're just getting started, put it into an index fund, I put mine into, I think, a high dividend REIT or something like that. That's totally different than everything else I have. So that you do something like that and it just continues to compound. And then, someday when we move back to the United States and our health insurance and health premiums are ridiculous again, then we can start using that. Right now, we don't really need it anyway. So being in Portugal. But okay, so I think if you have a couple more minutes, what other strategies would you like to talk about? What's one more that you might want to focus on as we end with a bang?
Yeah, I broke eye contact with you for a moment there for those actually watching, but I did want to mention that with the HSA, like it actually kind of turns into a traditional IRA after a certain age. So I was trying to Google the age real quick. I want to say it's 65. So let me see what I have written here. I wrote this a long time ago. It says, if you don't use it for medical, you can pull it out like a regular traditional IRA after age 65, and there's no 20% penalty. So you just pay the income tax at that time. So it kind of, this is not like official wordage here or verbiage, but like it kind of turns into a traditional IRA, right? The HSA, the benefit is like you pull the money out, you use it for medical, and you don't pay tax. But if you've got a ton of money in there, you've reached age 65, let's say you're healthy, right? You can actually then start pulling money out after age 65 and you don't pay the 20% penalty. You just pay the income tax on whatever your tax bracket is at that time. And then so that's not a lot.
I was going to say, could you put it into a Roth IRA at that time?
Probably not.
Got to be a traditional. Okay.
Yeah. 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 And then on this sort of health topic before, and you'll have to ask me that question again because I kind of forgot what your original question was, but on this sort of topic of medical insurance premiums and HSAs, when your business is taxed as an S corporation, there's a way to incorporate those two things into payroll. And actually, I should probably say not there's a way to, it's actually the proper way to do it to save you even more money on Social Security and Medicare tax. That might require some unpacking because that might not make sense if you're just hearing it for the first time. You tell me if I go on too much of a tangent here. Let's say you've determined that $50,000 was reasonable compensation to be paying yourself in your S corporation. Well, you got to, do it properly. We won't talk about the mechanics of it right here, but basically, let's also assume that your health insurance premiums and I don't know, HSA contributions are also 10,000 for the year. That's probably a low number, especially if you're in the States, but let's say it's 10 grand. Well, there's a way to actually only run payroll for 40,000, the amount of the health insurance premiums and HSA contributions. So you've determined that reasonable compensation was 50, But because you have these healthcare expenses, you actually only run payroll for 40. But the IRS is going to see that with the way you do the W-2, that you actually paid yourself 50. And so what that does is that saves you 15.3% on the amount of the health insurance premiums and the HSA contributions that you're doing. So I would say, I don't want to throw a generic number out there because I don't know, but I wouldn't be surprised if well over 75% of the CPAs out there are not doing it this way, because it's not necessarily doing it wrong, but they're not thinking about it as a strategy and saying, like, how could I reduce my FICA taxes, which is Social Security and Medicare, by incorporating my health insurance premiums?
Well, and not only that, but that 50,000, let's say it's 50,000, is also the basis for the retirement contributions we were talking about before. So you could, isn't that right? Like you don't have to. So if, let's say it's 25% is what you can contribute to retirement if you're an S corporation based on your salary. So instead of only being able to contribute 10,000, if it was 40,000, you could actually contribute 12.5 if you on the 50,000. Am I doing that right?
I don't know. I like to walk through these things in detail, but I don't know if we have time for all that. But so if you were running payroll for 50 and you determined that was your reasonable comp, right? You let me know if I missed the point here, but you could defer, I believe it's like 22,500 this year into either a Roth or a traditional 401k plan.
Okay, yeah, that's correct. That's correct. I'm not talking about that. I guess I should clarify. I'm talking about either the employee contribution to a solo 401k or the employee, well, it's employee employer, I can't remember, or the contribution to a SEP IRA. It's a maximum of like 60 some thousand or 25% of your income. So if you're taking a salary for 50,000, you're not going to be able to contribute 66 to your SEP. You can only contribute 25% of your salary, but the salary would be 50 because they would be taking into account the health insurance premium in addition to the salary you technically paid yourself. Am I getting that right?
You're exactly right. Yeah, you got it, Jim. I understand what you were trying to say there. So yeah, you got it right. It's 25% of the W-2 wages. So you're saying implementing this strategy helps you put a little bit more into the retirement account.
It's like double whammy there. You save the 15.3% and that's additional money you can contribute to retirement based on that. So I guess a better way to say it would be you get to contribute an extra $2,500 to your retirement for the amount that you paid for 25% of your health insurance if you run it through your business payroll.
Got it. And I'm getting too nuanced here. So I don't know if your audience matters, but so if you determined 50 was your reasonable comp, what you're saying is correct, right? 25% of that 50. Just to clarify for the audience, I'm saying like, yeah, we're still going to on paper have payroll of 50, but we're only actually going to run 40,000 of it or so through sort of what I'm calling the payroll system. Basically what I'm saying, only 40,000 is going to be subject to Social Security and Medicare taxes.
No, yeah, that makes sense. And when you run it through like Gusto, they let you do that. They let you there's a way to set it up. So it's like how much of this is health insurance. And then they calculate all that for you when you run the payroll.
But I think, and I could be wrong here, but I think when you use a service like that and you're not thinking about it strategically, what you will end up doing is you'll run your payroll for 50, and then when you put it in the software, it's actually going to add it to the top. So now your reasonable comp is 60,000. I'm saying like, think about it in reverse, like back down your reasonable sort of comp number and then add the health insurance premiums to that. So you're still landing at 50.
And for those of you that are listening, if you don't understand like the difference of what we're talking about here, the difference being that you still, even though you don't have to pay that extra FICA on the health insurance, you still have to pay income tax on that for wages. Now, it's weird because it comes out in the wash because then you end up deducting it on your 1040, but when you run the payroll, you have to pay the income tax on the health insurance in addition to the salary. So that's the difference. So you can kind of, that's the idea, right? That's what we're talking about.
That's correct. I mean, the purpose of this discussion, we're just talking about the strategy here, and then to implement the strategy, certainly get with a tax professional to help you implement that. Yeah, one Jim. Sorry, I was going to say one little. I don't know if nuance is the right word, but like back to that term that I use, voluntary after-tax contribution. I just want to let your listeners know about this. So, like we said that the limit for 2023 is $66,000 for getting money into a retirement account. And when people think about that, they sometimes will just think, okay, well, if let's say 22,000, I think it's 22,500 of it is through the salary deferrals, right? I don't know. I've got a calculator here. Let me see if I can do the math. So 66,000, if I subtract 22,500, that leaves us with 43,500. A lot of people think that they can only get that 43,500 in there if they pay themselves like, I don't know,
240,000. Yeah.
170. Okay, okay, so you know the number, like 200 grand, right? But that would be crazy because then you're paying Social Security and Medicare tax on the $230,000 of wages. I just want your listeners to understand that with this voluntary after-tax contribution thing I'm talking about, you could actually probably pay yourself, I don't have the exact numbers, but I think it's $70,000 or less and still get 66 grand into the retirement account. I don't want your audience thinking I'm suggesting that they run payroll for like 170 or the number you mentioned in order to make that happen.
Okay, you're exploding my lawyer brain because that's always not the way I've thought about it. So I need to do a little bit more research on that. But and I don't doubt that you're absolutely correct. It's just I've never heard of it that way. That's interesting. I did not know that.
Do you want to try to unpack it or not? That's too much.
No, give me tell me how does that work? Because I thought, and again, as a lawyer, we look at the law, the way it's written, and it says up to 25% of your salary of what you pay yourself. So that's kind of what, but maybe it's coming out of a different category. I'm not sure.
Yeah. So this is what people don't realize. So earlier when I said, hey, some brokerages don't let you do this, right? And you were like, hey, I think I think E-Trade lets you do this and Vanguard or whatever the companies you said. What I meant by that is their default trust documents for your 401k don't allow this. They're like, they're basic, I don't know what the term is. It's a very basic expression that people use, but like run of the mill like forms, right? So they will allow you to invest the money once you get it in there, but their basic legal documents won't let you do it. So what you have to do is you have to work with typically like a third party company. They will restate your trust documents and put the language in there that allows you to do this. And so like I was saying earlier, it's called a voluntary after-tax contribution. So they allow you to put that money into the brokerage account and then you can invest it there. So that might have been a little bit much, but like, the E-Trades of the world and out there, you can, once you get that money in, you can invest it. But their default trust documents wouldn't allow you to make that voluntary after-tax contribution. You've got to work with someone else who can restate those trust documents.
Okay. All right. So that's a little bit more complicated than I thought. So yeah.
Yeah, you're definitely not doing this on your own, right? You're not looking this up on a YouTube video. Yeah, for sure. And just for clarification, even your CPA is not doing this. They would be guiding you towards one of these companies that can restate your trust documents and then, help you with it.
Okay. That's good to know. All right. So I think that's a good place to kind of wrap up as the importance of kind of what you do, Navi. And so why don't we end by you just telling us a little bit more about I know right now you maybe are not taking on any individual clients. I don't want to misstate, but I think that's what you told me before. So, but you do have some resources and tools that people can still use to kind of help themselves as they're trying to navigate these waters. Because I personally am not a tax attorney. I'm not a tax accountant. I don't try to pretend to be one, although sometimes I guess on YouTube I do. But I do not help clients with this type of work. So why don't you share kind of a little bit about what you do and who you help and how people can reach out to you if they need to?
Sure. You're correct. At the moment, I'm not taking on any new clients, right? Most CPAs kind of aren't. However, there's two resources I would refer you to. So number one is the free resources are on the YouTube channel. And, when I create content, I kind of try to pull out all the fluff, jump into the facts, tell you what you're going to learn by watching the video, and then teach you that strategy, right? That's the free resource. Sort of the paid resource, if you will, is if you go to my website, it's navimarajcpa.com. I know that's not super easy, like, Jim Hart, but navimarajcpa.com. And there's a course that I developed. The course is very reasonably priced. and you can I teach you how to incorporate all these strategies. So I give you the basics about accounting. I give you the basics about tax. And once I teach you that foundational knowledge, I then teach you the tax strategies and show you how to implement them. So there's a lot of people out there that just talk about the tax strategy and then they're like, hey, how are you implement it? That's on you, figure it out. But with the course, I not only teach you about the high level tax strategy, I actually take it a step further and show you how to implement it within QuickBooks so that your bookkeeping is nice and tidy. You've implemented the strategy and you can actually just take those financials at the end of the year, give them to a tax preparer, like the regular tax preparer that we talked about in the beginning. And since the strategies are baked into the financials, they don't need to be a wizard in taxes to save you the money because they're just going to be plugging in the numbers. The tax strategy is already there.
Awesome. Well, Navi, thank you so much for being with us today. I really appreciate it. And I would highly recommend everyone listening go and check out Navi's stuff, and definitely check out his YouTube channel. He's a wealth of information. He explains it really easily in a way that most people can understand. And he helped me a lot. Like I said, I had an S corporation issue from earlier this year, and he told me what to do. And hopefully it worked. I don't know. We'll find out what the IRS says about it, but I think it'll be okay. So thank you, Navi. I hope you have a wonderful day. Appreciate you being here.
Absolutely. Thanks so much for having me, Jim. I appreciate it.
Do you own your own brand name? Are you sure? Chances are, without a federal trademark registration for your brand, you don't own squat. That's why we offer a free strategy call to speak with you about the plans you have to build an amazing brand and how we can make sure that it is actually legally protected. I can't tell you how many entrepreneurs out there have a great name for a brand or a great idea for what they want to build, but when we do the research, we find that it actually is not even available to them. Now imagine not finding this out until you have built a successful business over the course of several years that is now forced to undergo an expensive rebrand when you get a cease and desist letter from another business that you've been infringing upon all that time. Yikes. Don't let that happen to you. Head on over to hawthornelaw.net to schedule your free brand strategy call today. Once again, that's hawthornelaw.net, and you can schedule a free strategy call with me to talk about your brand and what you're trying to accomplish. All right, all you Legal Gym listeners, now that you know more about how to save some money on your taxes, you are ready to implement. Because if there's one thing we love to do over here at the Legal Gym, it's to take massive action. So if you haven't already, make sure you check out the show notes page for today's episode. You can get a rundown of all the links and resources we talked about here today by visiting hawthornelaw.net/Navi. That's spelled Navi. Once again, that's hawthornelaw.net/Navi. That's going to be the home base for all of your legal and business tools and resources to help you start, build, and of course, legally protect your very own online business and get your brand protected today. Thank you so much for listening. I look forward to talking with you in the next episode.